Hello, my name is Jeff Evans and I'm going to take you through the final accounts preparation, the sample one off the AAT website. I filled in quite a lot of the boxes just to save time, but I'll go through it and explain it to you as we're going along. So the first one is an incomplete records question. So we can see from this one, it said the task is about restructuring the general ledger accounts. It said you're working on the accounting records for a sole trader for year ending 31st of March 27. Business is VAT related, registered even. And they see we've got these various day book summaries. So we've got sales day book, sales returns, purchase and purchase returns, okay? And then we've got our balances, so our trade receivables. So we've got a balance brought down of 17,360 and a balance carried down of 18,940. Same with trade payables. Okay, we've got our opening inventory and our closing inventory. And then we're giving the opening balances so far as the VAT is concerned, and the same with the bank. We've then got some more information to do with general expenses. And it tells us that these general expenses here are not processed through the purchase day book. £9,012 is posted general expenses account. All VAT on these expenses is recoverable, so that 1502. Cash sales of 4,200 were made, excluding VAT at 20%, which out of interest is £840. And it said the total banked was posted to the cash sales account. All purchases on credit terms, and it says the trader took advantage of prompt payment. We've then got these receipts and payments as far as our bank is concerned. So amounts to our credit customers, so from our credit customers, so from our trade receivables, we've received £187,408. We've paid our suppliers £145,137. We've banked cash sales 5,040. We've received a loan of £8,000. We've paid rent 6,700. We can see those general expenses here of 9,012. We've from HMRC VAT, we've made a payment of 6,169. Drawings, so the owners have taken drawings out of the business, 23,000, and then we've got wages paid of 15,500. So again, for this question, we need to check, see what is it we're being asked to do. And it said using only the figure supplied, find the missing discounts received, sorry, the discount figure, by preparing the purchase ledger control account for the year ending 31st of March 2007. So what we'll do is we put in the figures that we've got to try and find out the figures we've not got. So obviously for our purchase ledger control account, our suppliers, we've got an opening balance here of trade payables of 13,345. So meaning that we owe our suppliers 13,345. So we've done a balance brought down of 13,345. What I say to my students at this point to do the purchase ledger control account, and same with sales ledger control account, but let's stick to this one. So what would increase the amount of money that we owe our suppliers? Yeah. So this is saying that we basically currently owe them 13,345. So what will increase the amount of money that we owe our suppliers? And obviously that's purchases. What would reduce it? So what would reduce the amount of money that we owe our suppliers? So any money we pay them, so bang, any discounts received, or any contra entries, or anything along those lines. So again, always think about it along those lines, as I say. So for this one, first thing we do is, so did we make any purchases in that month? So let's go back up to the purchases figure, and we can see that we made purchases of 149,349. Yep, so that would have been, wouldn't it? It would have been debit purchases, debit VAT, which I think we'll do later, and then credit purchase ledger control account, which is what we've done. We then have a look to see if we've got any other figures. So we've done the purchases. Have we got any purchase returns? None. Okay, so we don't need to bother about that. And then have we paid them any money? So let's have a look. So purchase ledger to our suppliers, it tells us here that we've paid our suppliers. Should click these off, shouldn't you? So we've paid our suppliers 145,137. Okay, so we can see I've messed up. I made a mess there, haven't I? I put the wrong figure in. Don't be me. So therefore, figure. So we paid our suppliers 145,357. Okay, and the figure we're trying to find is the discounts figure. So the missing discounts received figure. So we need to have a look and see. Well, we've been given the balance carried down figure. So we see that was a balance brought down, 13,345, and the balance carried down is 14,656. So I've put that figure in. So therefore, we need to find what is the missing figure. Yeah. So obviously, the balance carried down for that month would be the start of the next one. Would be balance brought down. This one is we've tried to find the discount figure, which is the missing figure. So if we put discounts in here. So discounts received. So discounts received from our suppliers, and it's the balancing figure. So we got 162,693 minus 157,793 or 159,793, which means we've got a discount figure of 2,900. And you'll see that that balances. So we now found what the missing figure is. So key thing about these is put in the figures that you've got to then work out the figures that you've not got, okay? The next one is a VAT control question. And again, similar process. And this time we're trying to find out what the closing balance is on the VAT control account. So let's go to our opening balance. So our VAT figure is up here. So we've got an opening figure, a balance brought down. On the credit side, it tells us of 1806. So I'm going to go to the VAT account and I'm going to put the balance carried down of 1806. Okay. And then we look at, so what else goes on the credit side of our VAT control account? And you remember from your bookkeeping transactions, bookkeeping controls day, level 2, that we've also got sales, so our credit sales or our sales generally. So let's go to our sales day book up here, and we've got VAT of 31,820. So again, so VAT control, so sales day book, 31,820. It did tell us in the question that we had some cash sales as well. So cash sales were 4,200. And again, I said the VAT on that was, so 10% is 420, so 20% is 840. So on cash sales, it was £840, okay? We then go to the debit side, so our purchases. So again, we've got purchases. So we're going to debit on the purchases, which is 24,408. There we go. So purchase table, our VAT was 25,408. Those general expenses were here. So general expenses were 1502. So we're going to put that figure in. So 1502. Again, it tells us in the question we've got sales returns this time. So sales returns, as we know, is also a debit. So therefore, we're going to debit sales return 322. And you can see we put the figure in there. It then tells us in here that we've paid VAT 6,169. So we've got a VAT payment of 6,169. Okay, so credit bank, debit the VAT control account, which is what we've got here. So again, so we've put all the information that we need. So therefore, we can now work out what our closing balance is. And again, it's just a process of elimination. So it's the side with the biggest amount, so 34,466. minus the 32401, which gives us a missing figure of 2065. And then you see it balances. So our balance carried down is 2065, therefore becomes our balance brought down at the start of the next month. The balance carried down there. So therefore your balance brought down at the start of the next month is 2065. Okay. The next one, it said the total recorded in the cash book for the year ending 31st of March 20x7 was receipts, so money in the bank on the debit side. So we've got on the debit side 200,448, and on the payment side, on the credit side, we've got 205,718. Okay, so therefore, obviously, you just take one from the other. I always tend to do these as the T account. So when I drew the T accounts, I drew them on my sheet. So basically, we've got again the 205,718. What's that one? Sorry, yeah. Start again. So start again. So 200,448 on the debit side. So money in the bank of debit, money out of the bank credit, and on the credit side, we've got 205,718. So therefore, we've got a balance carried down, which is the difference between them, which is 1459. Okay, so 1459 is the difference between them. So you need to be careful. It says assume there are no adjustments. What will the opening balance? What will the opening balance bank account, in the general ledger be as at the 1st of April 2000x7. Again, if I had my board and I was drawing up the board, so I've got my debit, so I've got balance carried down on the debit side. So at the end of the month, so on the 31st of March, we've got a balance carried down of 1458, which therefore becomes the balance brought down at the start of the next month on the credit side. So again, just read the question. I'm tempted to say RTFQ because that's what we say, read the flipping question, but again, just be careful when you're reading that the 1st of April. You might try and catch you out and just say, what would it be on the 31st of March? So again, just bear that in mind. Okay. So the next one in relation to 1.2, and this question is, again, I filled it out. So gross profit margin. So gross profit over sales, net profit over sales times 100. So this one says, so the task is about incomplete records and applying ethical principles when preparing accounts. So it should show whether it's the following is true or false. So gross sales margin percentage is calculated by, it is gross profit divided by sales. So again, hopefully you're aware of that. And the next one says you're a trainee accounting technician who has prepares final accounts for a number of sole traders. And it said you have the following information about a business for its year end 31st of March 20x7. It is not registered for VAT, and it said the trader operates with a gross sales margin, so gross profit margin of 25%. It says inventory at the 1st of April 2006, so at the start of the year, was 5,050. It tells us that sales of 64,900 were made, and then purchases were recorded at 48,390. And what we need to do is to work out the cost of goods sold. So there's a few ways you can do this, but what I was tempted, because we know that the gross profit margin is 25%, and we know that the sales are 64,900. So if you do 25% of the 64,900, that will give you the gross profit. Sales minus cost of sales equals gross profit. Yeah. So therefore, if you've got the sales figure, which is 64,900, that's the 100%, and you want to work out what the gross profit margin is, then 25% of that is 16,225. Okay. So I know what my sales are, and I know what my gross profit figure is. So therefore, as a process of elimination, the difference between them is what is the cost of sales. So again, sales minus cost of sales equals gross profit. So again, so if you write those down, again, when I'm in class, I draw these on the board, so it's much easier. So anyway, so 64,900 minus the gross profit figure, which is 16,225, gives you 48,675, okay? Another way you could do that, if you wanted to, is if you know that the gross profit margin is 25%, and you know that the sales of 64,900 is 100%, then you could just do 75% of the 64,900 if you want. So again, a few ways you can do it. I'm just going to double check that just so that we can see. So 64,900 times 1, yeah. So 48,675. So write it down. So write down what you've got to work out what you need to find out. Because now we need to work out, calculate the closing inventory. So we've got the sales figure, yeah, so we can write that down. And then we need to work out what the actual closing inventory is. So hopefully you remember what the cost of sales is. To work out your cost of sales, it's opening stock plus purchases minus closing stock, okay? So sales minus cost of sales equals gross profit. Your cost of sales is calculated by your opening stock, so stock that you started with at the beginning of the year, and then purchases that you made, and then closing stock you've got at the end of the year. And again, you'll know from your level 2 days, that closing stock becomes the opening stock at the start of the next year. So again, write it down. So we've got the opening stock, which is 5050. We've also got the purchases. So opening stock plus purchases minus closing stock, which is the figure we haven't got, but we have got the cost of sales, yeah? So we know what the cost of sales is, which is 48,675. So therefore, let's add them together. So 5050 plus the purchases, which is 48390 equals. We're trying to find out what the closing stock figure is. So if we take off the cost of sales from that figure, so minus 48675 is 4675. So therefore, our closing inventory is 4675. And again, I'd always advise you just to check that by doing the calculations to make sure that it's correct. And I know that it is, okay? So this one says, you now compare the figures with the results of the physical inventory count at the year end, and the total physical inventory is £350 lower than your calculation above. So it's basically saying that according to our figures, our closing inventory is 4,755, but you've done your physical count and it's 350 lower. Anybody who works in retail will understand stock control and counting your stock. So similar process. So we need to find out, so why is that? Okay. And we go through all of these various things. Does it tell us what this business is? No? Okay. Okay, so we've got a process of elimination here, but what I'm going through them. So some equipment was used in the office was stolen during the year. Well, equipment isn't really to do with your cost of sales, so that's not really relevant, yeah? There were unpaid sales invoices at the end of the year. Again, that's not really going to affect your stock. And then it says a high value item was included twice in the count. So if you were counting it twice, then it will be more. And what we do know, that drawings can also be stock. So it's a good bet that the trader has made drawings of goods during the year. So he's not accounted for them, okay? So that's a good bet. So on that basis, so according to our figures, we calculated 4765, but when we counted the stock, it's 350 lower. So therefore, 4765 minus 350 gives us 4415. So that's our closing inventory figure. Okay. The next thing it says, the trade has a policy of allowing customers to settle their accounts 1 month after the sale is made. We had a good few discussions about this in the class when we did this a good few years ago. And we sort of came up with the idea that basically it says, so sales ledger, so they tend to allow their customers to settle their account 1 month after the sale is made. So what we did is we looked at what the actual sales figure was overall, which if I remember right was 64,900. So over the year is 64,500. And if you divide that by 11, which is what we did, I think that gave me 5,900. So therefore, the closest to that is 6,940. Again, logically, if your sales are 64,900, yeah, and it says that you allow your customers like 1 month, allowing customers to settle their accounts 1 month after the sale, then it's unlikely that you're going to be left with 64,900 at the end of the period, or 16,225, because it's per month, isn't it? So you could divide it by 12 or divide it by 11, and we decided that was the closest answer to it. So that's what we decided. Okay. And the next one says, you're now working on the final accounts of another client. So your manager is called away unexpectedly. So you're working on something. He's asked you to undertake a particular task with a deadline during his absence. You've not received any sufficient training to do this. Okay. So again, let's say you're working on the final accounts of another client. Okay, and your manager's gone away, so would you do the job to the best of your ability and submit the work to the client on time? No, because it could be wrong, so that's most definitely not the case. The logical one, as you can see, is you go and ask somebody, don't you? So ask somebody for some support in the organisation. Seems a sensible thing to do. I don't think you're going to ask a family member and then advise the client the deadline will be missed. So again, that one, apart from being the most sensible, the others don't really seem to make that much sense. Okay. Next one, 1.3 is. So this one is to do with, so the task is final accounts for sole traders, and it said you have the following information about events on the 1st of January 2007. A sole trader started business. The business is not registered for VAT. And it says the sole trader has transferred £13,000 of his own money to the business bank account. And again, you remember for another 2 days, you would have debited the bank and then credited capital. Okay, and that's all we're doing with this one. It says £1,100 was paid from his account for some office furniture. So again, this is from the bank account. And it says that £900 of goods for resale was purchased, and the supplier allowed 1 month's credit. Okay, so we're basically doing so the opening capital. So it's to complete the capital account on the 1st of January, showing clearly the balance carried down. So again, we've got that first one, which is debit. So it would have been debit bank, credit capital. So we credit capital for £13,000. As I said before, so far as the £1,100 was paid from this account for office furniture, that's from the bank account, so it's not from his capital account. And then £900 of goods for resale were purchased. The supplier allowed 1 month's credit, so that wouldn't be included in this anyway. So therefore, we got a balance carried down of 13,000. The next one says you're now working on the final accounts of another sole trader, Onyx Trading, and it says you are to prepare the statement of financial position for Onyx Trading at the 31st of March 2007. It said the final trial balance is below. A profit for the year of £42,495 has been recorded. And it says using the information, complete the following task. It said calculate the value of trade receivables that will appear in the statement of financial position. Okay, so we've got, it said Onyx has a policy of showing trade receivables net of any allowances for doubtful debts. So we look at our trade receivables, our sales ledger control account, and we can see here that our trade receivables is £25,660, but we've also got an allowance for doubtful debts of £1,200. So even though our customers owe us £25,660, we've put some money to one side just in case they don't pay us, okay? So therefore, as it said here, our trade receivables is calculated by taking off the allowance for doubtful debts, which is 24,466. Trade receivables minus our allowance for doubtful debts gives us what our figure will be, okay? So then we have to complete the statement of financial position. And again, I should be ticking these off as I'm going along. So we've got equipment, so our non-current assets, as you know, so our long-term assets. So like motor vehicles, fixtures and fittings, equipment, so on and so forth. So we look through our trial balance and we can see we've got equipment here. So equipment at cost of 32,800 with a cumulative depreciation of 14,350, giving us a carrying amount of 18,450. Cost minus accumulative depreciation, 18,450. So that's our non-current assets. We've then got our current assets. Okay, so again, your current assets, those so-called floating assets, those assets that change within that 12-month period. And the first one we've got is our inventory, and it's our closing inventory figure that goes into our statement of financial position. Opening stock, as you'll know, is in your cost of sales in your statement of in your profit loss account. So our closing inventory is 22,420. The next one we've got is our trade receivables. And again, our trade receivables figure we calculated is, have I done that wrong? I think I've calculated it wrong, haven't I? I've put in the wrong figure. Sorry, just let me double check. I do this quite a lot. Type in the wrong figure. So we've got, this one is 1.3. Yeah, 24,460. So 24,460, that should be 24,460. Just me being a dope again before, yeah, see? 24,460, sorry. My mistake. So 24,460 was the difference. I'm sure you'll have done that as you're working through it. Yeah, you know, that was wrong. So 25,660 minus 1,200 is 24,460, my apologies. So your trade receivables, as you can see. We've then got prepayments, okay? So prepayments, something that we've paid in advance, would also be a current asset. And it tells us in here, we've got prepayments of 900. Good thing to do is to always check that, because sometimes prepayments isn't there. So just check it, and also check to see if you've got any accruals, just in case, because people get in the habit of not putting those figures in. So this one we have, so we've got prepayments, tells us is £900. And then we've got money in the bank of 1,645. So therefore, that gives us our total current assets, if you like, of 49,425. We've then got our current liabilities. And again, our current liabilities are trade payables, our suppliers. So our trade payables are purchase ledger control account. So 16,720. Again, look to see if we've got any accruals. So any accruals as we have, we've got some accruals at the top of 1,940. So again, those liabilities we've got in the short term. Long-term liabilities would be called non-current liabilities, and they would be things like bank loans, mortgages, so on and so forth. So we've got accruals. Again, check the question, because this one it says we've got payroll expenses, which is an expense in your profit loss account. But we've also got payroll liabilities, meaning we've got £630 that we still owe. So that's why it's a liability. So again, just double check. And then we've also got VAT, which you can see on the credit side. So we still got VAT that we owe. So again, you add those together, which gives us your total current liabilities of 23,180, giving us net current assets. So 49,425 minus the 23,180 gives us our net current assets of 26,245. Okay. Net assets overall, so that's our non-current assets, our fixed assets, 18,450. Those assets we buy for the long term, plus our net current assets of 26,245 gives us 44,695. Okay, so we've got our assets, and then we've got our liabilities, and then we've got our finance by. Assets minus liabilities equals capital. So we're doing the capital bit of this now. So again, it tells in the question, we've got opening capital. So capital in the trial balance here of 22,200. So that's our opening capital. And then we add any profits that we've got in the year. So it's like retained earnings, opening capital plus profits for the year, or minus any losses if we had them. And then we take off our drawings. So opening capital plus profit less drawings. So remember that's retained earnings. You'll do that at level 4. So opening capital plus your profit, and then less your drawings. So if you check your drawings, so drawings is what the owners have taken out of the business, 20,000. So you can see, so 20,000 are the drawings that have been taken out. 22,200 plus 44,695 minus the 20,000 gives us 44695. And we can see, as my students always feel really happy, I've got it to balance. When you come out of the exam and you made it balance, then you'll feel quite pleased with yourself. Okay. Again, forgive me, I should be ticking these off, but I'm just taking you through the question. Okay. Drawings, so this drawings now, so the closing, sorry, these drawings of 20,000. Okay, so drawings for the year will be transferred as a debit to the capital account, as we know. So your capital is on the credit side. So whatever is on the capital you've got, you take off those drawings by debiting it to give you a closing capital figure. Yeah. So I suppose if you look at your capital account, you've got your opening capital plus your profits for the year. And then on the debit side, you would have your drawings, yeah, which gives us your closing capital of 44,695. Okay. Next question, which is 1.4. It said the task is about the knowledge and understanding underpinning final accounts preparation. And it said, which of the list below is a benefit of running a business for a sole trader? Okay, so obviously a sole trader has got unlimited liability, which certainly isn't a benefit, meaning you're responsible for all of the debts. They don't have limited liability, so that's not an issue. So limited liability are those limited companies. But one of the benefits certainly of being a sole trader is that you've got control of the business decisions. So you make all the decisions. That can be a bit of a negative as well, but the point is you have got control of your business. Okay. Next one says complete the sentence. Again, the drop down is so a private limited company is owned by, so it gives you the options here. So is it by the directors, the shareholders, or the trustees? Okay. So a private limited company is basically owned by the shareholders. Okay. Next one says, which of the following business have owners with limited liability for its debt? So we've already said that PLC or sole trader was unlimited liability, but a limited company, such as a PLC, similarly, public limited company, that has unlimited liability for his debts. Which of the following businesses have owners with limited liability? So limited liability means you say you haven't got liability for your debt. It's what we call a separate entity. So the business is separate from the owners. Yeah. So therefore, Joe Bloggs PLC has limited liability. And as does Joe and Josine Bloggs LLP, so limited liability partnership. So they've got limited liability, whereas the partnership wouldn't be. So 2 and 3 has got limited liability. A partnership, they would be responsible. So they would have unlimited liability. And again, that would be something in their partnership agreement as to decide with how those debts or whatever will be paid. So key thing is limited liability. So PLC and limited liability partnership. The next thing says to be a charity, an organisation must satisfy the definition of a charity found in the Charities Act. Okay, I'm doing that quite a lot with my students at the moment, where they're looking at setting up a charity, and it's a charity act that lists all of the important things of what you need to do when setting up a charity, such as a company secretary, etc. Okay, its purpose must be for the benefit, not of the trustees, but of the public. Okay, so a charity is for the benefits of the public. International accounting standards, so an IFRS question. So I said, which of the following prescribes the format of final accounts for an organisation adopting IFRS standards? So International Accounting Standards 1 is how it's is what determines the format of the account. I do say to the students that when we talk about, sales minus cost of sales equals gross profit, or the format of the profit loss account or statement of financial position, we don't make it up. Okay, it's based because those structure of those things are set down in accounting standards. So in this one, it's International Accounting Standards 1, which is responsible for the format of the final accounts. Okay. Next one says, link the boxes to match the following users of final accounts with the most likely reason for their interest. Okay. It says, make a selection by clicking on the box to the left and then the one on the right. So in other words, management. So management, so far as what their main interest is. So I'll take it off for you. I think you remove it by clicking on it, don't you? Yeah, you do. Okay. So management, so their key things as far as management is concerned is basically to do with, let's have a look. It's this one. So to compare information from the other organisation operating within the same business sector, because you're having a look to see what's going on in the various sector. As a process of elimination, assessment for the security of a loan, that's not really the role of the management accountant, I suppose, or management generally. It's more so looking at what the organisation is doing in comparison to others. Decision making relating to personal investment is obviously to do with shareholders. That's their main thing, is about how they can get a return on their investment. Okay. That's the main thing, the main interest. It does say to assess future performance of the business, but really shareholders is about making a return on their investment. So they're the most likely answers to that one. 1.5 is to do with partnerships. Okay, so we've got partnerships, and it says which one of the following should be included in a partnership agreement. Okay. So again, so when you are forming a partnership, when you set down the rules of how the money's been appropriated and who's getting what, so on and so forth, then certainly not the appropriation account, because that's how the profits are basically sort of apportioned, as it says. Not the salaries and wages, because that comes out of whatever profits have been made, but certainly the rate at which the interest is allowed on the capital. Okay, so what rate of interest will be allowed on the capital that they put in. So what return will they get on the capital they put in? So therefore the partnership agreement will do that. Those other two particularly are to do with how we allocate the profits. Yeah, so this one is the most important. It now says you're following information about the partnership, business. So Riva, Sam and Terry have been its owners for many years. And it said on the 31st of March, Riva retired from the partnership. Goodwill was valued at £52,000 and has not been entered in the accounting records. So goodwill is things like brand name or reputation, particularly partnerships, as you're aware. So you're buying into a partnership because of the reputation, you're prepared to pay more than what it says in the financial statements. So that's goodwill, which is an intangible asset in the statement of financial position. So therefore, goodwill, £52,000. So debit goodwill, and then we would credit the capital accounts, which is what we would do. Profit share effective before retirement, 50% Riva, 40% Sam, and then 10% Terry. And then the profit share after retirement is 70-30. It said goodwill is to be introduced in the accounts 31st of March 2007 with a partnership change and then immediately eliminated. So goodwill, so you would debit goodwill as we've done here, credit capital of the individual accounts. So the double entry would have been initially, so we're going to debit goodwill for Riva, and again 50% of Riva, so it's 26,000. Sam has got 40%, which is 20,800, and Terry has got 10%, which is 5,200. Again, the double entry for that would have been, so we debit goodwill as we have here, and then we would credit the capital account for Riva, Sam and Terry for those amounts. So that would be on the credit side. Okay. Again, if I was in class, I would draw the full T account so you can see how it all fits together. And then it says we're now going to eliminate goodwill immediately using the new profit share. So therefore, again, if you imagine that on the capital accounts of Riva, Sam and Terry, on the credit side, you'd have 26,000, 20,800, 5,200. And now we're going to basically close that account with the balance carried down. So again, I'm just showing you how it would fit. So you would debit the capital accounts and credit the goodwill account with the new ratio. So that's all we're doing here. So that 52,000 now is split on the basis of 70% for Sam and 30% for Terry. Okay. And again, if it was in class, I'd show you how it all fits together from both sides of the accounts. Hopefully that's clear for you. It's worthwhile drawing them so you can see how it all fits together. The next thing says you've got the following information about another partnership. The partners are Asma and Ben. The financial year ends 31st of December and there is no interest on capital or drawings, okay? It says figures related to for the year and 31st of December 2007 were as follows. We've got a profit share, so it's 60% to Asma, 40% to Ben. Salary per month, 1,950, 1,400. Sales commission during the year, 4,500 for Asma, 8,300 for Ben. And then there's drawings of 28,000 over the year for Asma and 2,000 each month for Ben. So again, you know, they're throwing these things to try and catch you out, okay? So again, just for our purpose, and I should add at this point, I've done quite a few videos to do with the synoptic assessment, and on the synoptic assessment, the practice ones, there is one for partnership and appropriation account. So again, it's important to understand these and then how it works as far as your actual spreadsheets are concerned. So again, when I teach this in class, I tend to do it on a spreadsheet. So you get a good understanding of all the formulas as you're apportioning these costs, okay? So again, let's do the appropriation account. So it says profit for the year prior or before appropriations is 80,000. So again, I put these figures in to save time. We've then got the salaries, yeah, so it's for the year end. So Asma, so she's got salary per month of 1,900, so 1,950. Yeah, so if you multiply that, so 1,950, 1,950 times 12 is 23,400. So again, so what we're basically saying is we've got profit of £80,000, and how we're going to appropriate that, in other words, split that between the two partners. So out of the 80,000, we're going to pay a salary of 23,400 to Asma. So far as Ben is concerned, so that's wrong, it shouldn't be drawings, wrong drop down, it should be salary. So far as Ben's salary is concerned, again, 1,400 a month times 12 is 16,800. So we've taken the salaries off. We then also need to take the commissions off. So out of the profit, we're also going to pay in the sales commission that they've earned. So 4,500 to Asma, 8,300 to Ben, which basically means we've got left or residual profit for distribution. So we got 27,000. So we started off with a profit of 80,000. After we've paid the salaries and commissions, we're left with £27,000, okay? And that is going to be split. So the profit is then going to be split on the 60-40 ratio. So 60% of 27,000 is 16,200. And that goes to Asma. And then the 40%, 10,800 goes to Ben, and that should equal 27,000. So you know that you've got that right if those two figures add up to 27,000, okay? It says on the 3rd of January 20x8, Ben takes some goods for his personal use, okay? So his current account will be, so remember in his current account, if he's got money in it, it's on the credit side. Yeah, so in his current account, if he's got money in it, it's on the credit side. So therefore, because he's taking goods out, we're going to debit his current account. And that's what that means. Okay, nearly there. And then on to 1.6, which is the last question. And it said the task is about final accounts, partnerships, and an introduction to reporting regulations for a limited company. He said you are preparing the statement of profit loss for Onyx Partnership for the year ending 31st of March 2007. So the partners are John and Pat, who share profits and losses equally. This is their only entitlement to profit. You've got the trial balance here, and I'm just going to draw your attention to John and Pat. So John and Pat have got capital of 14,000 in their capital accounts. They've also got 14,000, or Pat's got 14,000 of capital in his account. But they've also got on the current account as well. So they've got money in their bank. So John's got 780 in his account and Pat's got 390 in his account. So just check to see if there's anything on the debit side, just because they might try and catch you out. And so therefore, we're going to prepare the statement of profit and loss, okay? I will do it properly this time by ticking the boxes. So I gather for a lot of you, I mean, I tend to bring this in early in advanced bookkeeping, just so you've got a good understanding of the format of a profit loss account and a balance sheet. So for our purposes, so we've got our sales revenue. So our sales revenue, our sales figure is 255,480. Again, just double check to see if there's any sales returns, because you might need to put the net sales figure in. So just bear that in mind. So our sales is 255,480. In one of the previous questions, we talked about the cost of sales. So that question we did on incomplete records. So again, I do stop my students sometimes in the corridor. So what's the format of cost of sales or how do you calculate gross profit? So again, remember, so you're opening inventory and it gives you in the trial balance or opening inventory is 24,500. So as our opening inventory plus purchases. So purchases we've made are 153,670. And then we've got our closing inventory. So closing inventory is here. So closing inventory, 25,100. Opening stock plus purchases minus closing stock gives us our cost of goods sold or our cost of sales, okay? Sales minus cost of sales gives us our gross profit, yeah? Sales minus cost of sales gives us gross profit. I can't not do this because it's a habit. I'm just interested in what the gross profit margin will be at that point. So I'm going to go 102,000, which is the gross profit, 410, divided by the sales, so divided by 255,480 equals, times 100, equals 40% gross profit margin. Yeah, good for you to know that for future reference. So gross profit margin of 40%, that means we're making 40 pence in the pound. I usually say to students, if I sell you a bottle of wine for £10, how much have I made? 40% of £10. So I'm making £4, yeah? So gross profit margin, I can't help but do that, forgive me. So gross profit, sales minus cost of sales equals gross profit. We've then got anything we need to add, okay? So you might have interest received, or you might have some discounts you've received, or whatever the case may be. But this one, we've got an allowance for doubtful debts. So just as a reminder, we've got, I think it was one of the previous questions, I think it's probably on advanced bookkeeping, but our sales ledger control account is 30,660. We've made an allowance for doubtful debts of 850, yeah, but sometimes we've put too much to one side, yeah. So in this one, we've got an adjustment of 600 on the credit side, meaning that the allowance that we'd put to one side was too much. So we've got an extra £600. If it was on the debit side, it means it will be an expense. We didn't put enough on one side, so that will be an expense. Well, because it's on the credit side, it's income, as you know, from your debt or your click. So therefore, the allowance for doubtful debts adjustments is £600. So gross profit plus your allowance for doubtful debts adjustment. So then we've got our depreciation. Sorry, I did say I'd tick them off. I've not done them, have I? Allowance for doubtful debts. We did the closing inventory. I think we did that somewhere. Stock, yeah. So then we got our expenses. So again, we look at our expenses. So we've got depreciation. So depreciation is an expense that goes in our P&L. So 9,700 is our depreciation charge for the year. We've then got, looking through them, I'd probably put loan interest paid in there because I'm going down the list, but that's fine. So office expenses, we've got office expenses here of 31,630. We've got payroll expenses. So our expenses, as you know from your dead and click, so 16,950. We've got selling expenses of 10,542, and then loan interest paid, which is an expense. So loan interest payable, loan interest paid, sorry. So loan interest paid, so we paid £106 interest on our loan, which gives us our total expenses of 68,990, okay? So therefore, you've got your gross profit, 102,410, plus your 600 for your allowance for doubtful debts, minus your total expenses, gives you 34,020. That's your profit for the year, okay? It now says we're now going to calculate John's share of the profit or loss for the year, okay, in his current balance account. So it says use the minus sign to indicate only a loss for the year if necessary. So John's share of profit and loss. So we've got his, what was John's share? So if we go to John, it's equal, isn't it? So I do apologise. So John, it's equal share. So John has got a profit share. So 34,020 divided by 2 mean that John gets a share of profits is 17,010. So half of that it goes to John. And his final current account balance. So if you go back to the trial balance, as I said before, well, John has already got £780 in his current account. So therefore the 780 plus the 17,010 means that John has now got a final balance in his current account of 17,790. Okay. He said, where will the current account balance of John's appear on the statement of financial position? For Onyx, and it'd be in the finance by, because at the bottom of your statement of financial position, was that up here? Let's double check. It tends to be at the bottom, doesn't it? Where was it? See, it does tend to go on the bottom here where you show it sort of like the share of the capital. So it'll be split between this capital and how it's apportioned accordingly. Okay, so it's on the finance by at the statement of financial position. I think that's it. So I hope you found it helpful. We've got one more question, forgive me. It also says preparation of final accounts for a limited company at year end requires a more detailed reporting than for a sole trader or partnership. So again, so preparation of final accounts for a limited company at its year end has a far more detailed reporting than a sole trader or partnership. And it says, which of the following statements are true for a limited company? So a taxation charge should be shown in the statement of profit or loss. So yes, that one's true because you show that in your P&L as far as your tax is concerned. Certainly the tax charge you would show in your profit and loss account. Tax payable would be in your statement of financial position. But for your profit loss account, yes, your tax charge would be in there. A full analysis of the non-current assets must appear on the face of the statement of financial position. Not necessarily, it's just recording it as you would do normally. But notes to the financial statements are available to third parties. And that's definitely the case because you've got some adjustments that you need to make, or if you need to explain some of the notes or some of the issues that are in the financial statements, then again, you'll see that in the notes. If you have a look at some of the public limited accounts, or if you look at Tesco's, or I saw a really good one of Microsoft. So again, if you look at their accounts, you'll see that there's lots of notes explaining sort of like what all the elements and all the adjustments are. Okay, that's it. So I hope you found it helpful. I will do another one just to hopefully give you some guidance. Thank you. Bye-bye.